I'm Linda Eedes and welcome to today's Mind of the Manager webinar. The topic for today's session is Beyond Borders, Building Resilient Portfolios in a Low-Growth World. Now, around the world, long-term growth expectations are being revised downward. We've seen the likes of the IMF and the World Bank both projecting that global GDP will expand at a far slower pace over the next few years, as has been the case historically. Now, this subdued outlook, of course, reflects rising trade tensions, of course, policy uncertainty, but it's also becoming clear that the tailwinds, which really fueled a lot of the expansion over the previous decade, and here I'm talking about the ultra-low interest rates, I'm talking about globalization, very high levels of government spending, can no longer be taken as a given. Now, Trump's tariffs have added a fresh layer of unpredictability for the global economy. But here in South Africa, our own structural issues are also continuing to weigh on investor confidence and investment, even from an already low base. So as investors, we all face the same challenge, which is how do we continue to generate real returns given that we're sitting in a world of lower economic growth? So that's exactly the topic that we're going to be tackling today, although through two very different, but hopefully highly complementary lenses. First, we'll hear from Wim Murray, one of our portfolio managers based here in Cape Town. Wim is going to walk us through the South African equity landscape, and he's going to show us how select companies are still managing to outperform despite the macro backdrop, through innovation, self-help, or simply surviving where others haven't. Then we're going to cross to Xue, who is one of our portfolio managers joining us all the way from Singapore. JC will take us deep into China's rapidly evolving tech sector. He's going to be talking about AI, autonomous vehicles, semiconductors, and robotics, and explain why China remains one of the most misunderstood and undervalued investment opportunities globally. Now, we'll have a short Q&A after each presentation, if time permits, so please do feel free to drop your questions into the chat as we go along. But to get us started, I'm going to hand over to Wim to discuss how we're finding the best opportunities right here on our doorstep in South Africa. Over to you, Wim.
Thanks, Linda. So it's a privilege to talk to you today. We're going to look at how we go about finding opportunities even in a low-growth environment. And as Linda has mentioned, for anyone reading the news, whether the World Bank or IMF, growth outlooks are being tapered back. And for South Africa specifically, we saw the Treasury actually reduce GDP forecast for this year from 1.9% down to 1.4%. And this chart just shows the extent to which for South Africa specifically growth has actually declined over time. So very strong growth for 20 years up until 2015. And since then, for the past decade, it's actually come in below 1.4%. And unfortunately, the structural reasons underlying the low growth we do not believe is being adequately addressed and therefore are likely to persist. So at the heart of the problem is this chart. It's gross fixed capital formation, which lingers at record lows. And this is simply put investors' propensity to put capital into the ground within a country as a percentage of GDP. And we can see South Africa at 15% being well below where an emerging market needs to be closer to the 25% level. So investors staying on the sidelines, there's a myriad of factors at play, whether it's economic policy or an incompetent government, that's muddying the outlook, and it's difficult for investors to get a sense of what the country will look like 10 years from today. So we can see Europe, a developed market, at 22% being healthy, and then East Asia at 35%, seeing significant investment happening, and JC will talk to the opportunities that presents. So low growth outlook, where does this leave us as investors? Well, interestingly, today is actually a better time to be an investor than a decade ago. So this chart shows the mid-cap forward price to earnings ratio, which is a valuation metric used for what we would deem a proxy for SA Inc. stocks. And we can see valuations have come down by more than 30% over the past decade. So in 2015, we had a dire outlook for economic growth and for the country as a whole, but share prices were reflecting strong growth, not only for the economy, but also for the various businesses. And as the growth failed to come through and investors were disappointed, we saw these shares sell down significantly. And where we are today is broad-based pessimism. And we're seeing this indiscriminately being applied to all companies, and in some instances, unrightly so. And we think the growth prospects are actually much better. So this is where the opportunity sits. So we'll look at three buckets. There's the market share winners, and we'll talk around Capitec. There's the self-help stories, where management can actually deliver returns regardless of the economy. And then there's the last man standing, where an industry or a sector has changed to such an extent that those businesses that are able to survive are actually in a much better place going forward. Okay, so Capitec, market share winner. All of you will be familiar with it. This chart just shows the extent to which they've been able to generate shareholder returns despite the low growth over the past decade. And we can see for anyone having invested in the company a decade ago would have 8 Rand today for every 1 Rand they put in. And for us as investors, it's important to understand how was this achieved, and then to form a view of what does the future look like. Okay, so this chart shows the extent to which they've been able to grow their client base. And underpinning all of this is the fact that Capitec is the lowest cost producer of all the banks. So they are able to provide products and services at a lower price point than any of their peers. And as a result, you see the strong uptake in clients. The value proposition being attractive, increasingly more than the competition, means you're growing clients. As you grow clients, you actually get the scale benefits. This allows them to reduce pricing further. And as a result, we've seen total clients go from 6 million a decade ago, north of 24 today. And then at the very important bucket, that main bank client going from 2.4 million to 9.8 million clients. And that's where a lot of the income sits. So these are the clients that are actively using your card, swiping it, taking up products, and making payments, seeing their salaries being deposited. And the interesting line is actually that credit client line, which has declined from 1.5 million a decade ago to 1.2 million today. So despite growing their client base significantly, they've actually been very conservative and much more selective onto who they are granting credit, and as a result, we've seen the loan book improve accordingly. So let's just break down how have they actually delivered revenue. Well, we can see lending used to be 66% of group revenue. Today, it's only 33%. So some growth, but not much. Transactional has actually been a big driver of the business, and there we can see it's up 5.5 times over the past decade. So as they've added more clients, they've added more active clients, they're swiping their cards more, making more payments, and this has been a big growth driver. And then, as mentioned, being a lower cost producer and having very low cost of distribution to get products out, they've also launched new products and services. And they're able to do this at a price point that's often 70% cheaper than the incumbents. So they target a certain financial product where bloated financial incumbents have very fat margins and it's poor service, and they're able to come in at a price point for something, example, like funeral cover at 35 Rand for a comparative product and of 110 Rand of some of their peers. And as a result, you see very sharp uptick in any new product launches. So where we are today, insurance and value-added services, so this would be electricity, airtime, bill payments, etc., they contribute close to 4 billion to revenue today compared to 0 a decade ago. So very sharp growth coming out of those segments. Okay, so looking at the profit pool, understanding where they're making their money, and then forming a view of what it looks like in the future, we can see lending income actually only contributing 21% for the group and transactional being 24%. So the two main profit drivers a decade ago today accounting for less than 50% of group profits. We think transactional outcome will continue to be very strong as they add more main bank clients who transact more, and then they're also shifting up the LSM curve to higher income clients, which also transacts more. So good growth momentum within those spaces. And then within Insure and the new initiatives, which today account for close to 50% of the business's bottom line profitability, we think there's significant runway for them to not only sell into the existing client base, but also to launch new products into what is a growing client base in future. Okay, So where are we today? If we look at the monthly revenue generated per each bank, per client, we can see Capitec only at 124 Rand versus some of the other banks sitting closer to 350 Rand. So they still at a third of the other banks in terms of actually monetizing their customer base. And we expect this to increase meaningfully over time. It's probably the best management team in South Africa, so we rate them highly to actually deliver on the stated projects. And the business bank, which I didn't mention too, we think will also be a very big profit contributor over the next 5 years. So all of this will culminate into very strong earnings growth, which if they deliver on earnings over the next 5 to 7 years, the share price is sure to follow. Okay, so moving on to a self-help story, and this is Tiger Brands, which is very topical. They actually came out with results this morning. But it's a good example of how a good business, when poorly managed, can underperform. So we can see on the left-hand side, they have well-known and well-loved brands, number one in most of the core categories. But the share price has actually lagged and is still lingering at levels close to 2013. So what's changed? Well, they appointed a new CEO in Chad Kruger at the end of 2023, and he's been very quick to implement significant changes within the business. So they've had a bloated head office structure, which he reduced, and then he also simplified the reporting structure, having fewer employees and putting the employees making the final decision closer to the operations. So you have the MD that sits within the various divisions making the decisions, and they report back to Chad, who's the CEO. And what this allows you to do is not only make faster decisions, but higher quality decisions as well. And so they've been very active in actually cutting the tail of their brand. So we can see the non-core brands being disposed of, 4.5 billion to date, with potential brands of another 2 to 3.5 billion that they're looking to cut, with some of that, the Ace brand being announced this morning. So moving very quickly to get this done. And then as that frees up management time to focus on the core brands, it also frees up capital that you can then invest into the remaining business. And this is what we're seeing them do at the moment. So in terms of actual marketing and CapEx spend, it's been very stagnant over the past decade. And now we're seeing a step up in CapEx, both into manufacturing capabilities in order to drive the efficiencies, but also increased marketing spend behind the brands that do offer attractive returns. So we expect them to deliver meaningful efficiencies over the next couple of years. And as they get the price points right, it will also translate into volume growth, which we find very attractive. So all of this culminates into what we think is an inflection point for margins. They're cutting the tail and the loss-making businesses, investing behind the core brands. So we expect meaningful margin expansion to happen over the next few years. And what's important about this graph is in order to deliver on these initiatives, the factors that will drive the growth, we believe, are under management's control. So they'll be able to deliver regardless of whether it's a tough economic environment. And then all of this, it translates into earnings growth. We can see strong earnings growth being forecast over the next couple of years. And as you drive the earnings, you expand the margins, you actually see your return on invested capital improve and therefore warranting a higher rating. So all of this within a branded business, if you invest behind your brands, you get your margins right, at some point it starts to spit off a lot of free cash flow. And this can then go towards either reinvesting into the business or it can be returned to shareholders. So this morning in the announcement, we saw them both a dividend yield, a special dividend yield, and announcing they'll be doing buybacks as well. So very attractive proposition, and we think it's an interesting thesis for investors over the next 3 years. Okay, then Wilson Bailey, this is looking at the last man standing. So this chart just shows the extent to which the construction sector has actually been decimated over the past decade. So there used to be 6 prominent construction companies. Today, there's pretty much 2 left. But what's important to note is even though the overall market cap of these businesses have declined, the value have significantly shifted towards those that remain. So both Raubex and Wilson Bailey. And as a consequence of this, we've seen the remaining businesses actually winning large share of market share. So Wilson Bailey, this is their market share of large construction projects. And we can see it going from 12% in 2015 to 35% today. So very few businesses that actually do have the skills, the balance sheet, and the BEE credentials to deliver on these large-scale projects. And what this does is it allows them to not only see a strong growing pipeline of new business at work on which they can tender, but it also translates into strong order book growth. And this is across both the building and civils divisions, but also the road and earthworks book. So very strong growth flowing through. And then, of course, as your order book is growing and you reach capacity, you are in a position to pick the projects you do want to tender on. You can negotiate better contract terms, and you start to see the margin pick up. So we believe our forecast on margins are actually quite conservative. We can see the heyday of the World Cup investments where there was high demand for these services. We don't have it returning to those levels, but we do think with the landscape having changed, the economics of the industry is significantly different, and it will drive very strong margin uplift and order book growth for the businesses that remain. And again, as with the other businesses, all of this translates into earnings growth. So share price follows earnings. We think it's a strong outlook over the next 3 to 5 years. And at the current low valuation, we also think there's scope for multiple expansion, all of which will drive very strong earnings growth for the business and deliver for shareholders. So that's the end of my presentation. Hopefully it gives you some indication of how we go about finding opportunities across a broad segment of the market, all of which we believe will offer attractive returns to our clients, despite what is currently a very tough economic environment.
Thanks, Wim. Before we move on to JC's section, where he starts talking about similar opportunities, or very different, but opportunities in a different area, namely China, I just wanted to touch on Capitec, because I think many would agree that Capitec is a great business, but it has, for that reason, always traded at a high valuation. And, many investors would say a good business, bought at too high a price doesn't turn out to be a good investment. So what would be your thoughts on that?
Yeah, it's interesting. There's the two main pushbacks on the Capitec thesis are often they are unsecured lender, which hopefully some of the charts will show is not the case anymore. And then secondly, it's the valuation. And often what's being referenced is the price to book. Now, for traditional banks, the price to book metric is relevant because they need to extend their balance sheet in order to grow their earnings. But in the case of Capitec, we've actually seen them decoupling the revenue drivers from the balance sheet, and therefore it becomes much less relevant as a metric to look at. What we do look at is the price to earnings ratio, and there I would agree on a one-year basis it does look fairly full, and we could potentially have a flattish share price. But the moment you start to take a 3 to 5 year outlook, it does start to screen very attractive. And if you believe that they can offer growth for the next 7 to 10 years, then it offers very attractive returns to shareholders over the longer term. So it's the investment time horizon that's mostly the difference in terms of who owns Capitec and who doesn't.
Okay, fair enough. Thanks, Wim. So let's move on to a very different opportunity set in a very different so-called emerging market. Over to you, JC.
Thanks, Linda. Hi, everyone. I'm JC Xue, one of the multi-counselor portfolio managers on the Ford International Fund, Global Equity Fund, and the AsiaX Japan Fund. Today, I want to spend some time talking about China's underappreciated innovators, some of which we are invested in. And more importantly, I want to highlight China's rise as a tech powerhouse, as well as the related opportunities and implications. To start, one of the questions we spend a lot of time thinking about is, as global growth slows, how do we drive out performance? And as you can see in the next slide, right, the key that we think about is finding areas of misunderstanding where the market doesn't want to go, doesn't want to see, doesn't value. There will be opportunities to outperform. So this brings us again to China, where we continue to find just broad market underappreciation, despite some recent market recovery, which is why China continues to make up low double-digit exposure in the Ford International Fund, around 20% in our Global Equity Fund, and more than 50% in our Asia ex Japan Fund. I'll start first by examining what the market is not seeing enough of, highlighting cases of how China is no longer just a copycat, but innovating and creating world-class products with global rollout potential. Now let's start with AI. So the chart on the left, you can see a few logos of China AI companies. DeepSeek is probably the first everyone recognizes, being the Chinese language model that took the world by storm just a few months back. And for those who are less familiar, the DeepSeek model performed in many instances on par with the best like ChatGPT and was priced substantially cheaper for developers to use. And then it saw rapid adoption both in China and rest of the world. But beyond DeepSeek being a global winner, there's also this second logo here, which shows you Kling AI. It's one of the most used video AI models globally. Basically, you can just type in what story you want to create in text, and it creates the video for you. And that third logo is Manus, which is leading in building AI agents, basically AI that can perform tasks for you. For example, you can ask it to make a website, plan a trip, and do bookings for you. So each of these businesses are not just Chinese leaders, but also globally relevant. But I think the important point that I want to highlight here is that these are just 3 out of thousands of AI algorithms that have been created in China as of April 2025. An AI algorithm would include not just language models, but also things like diverse applications like automated advertising creation tools, voice agents for customer service, etc. Basically, the AI ecosystem is blossoming in China with hundreds of new algorithms being launched each month. And by 2026, we think it will grow by another 50%. The DeepSeeks, the Klings of the world is just a start to what is likely to be a lot more to emerge from these thousands of algorithms over time. Now, the other thing to highlight here is the table on the right, which shows the global language model leaderboard. And here you can see companies we own, including Tencent and Alibaba, both having models that rank top 10 globally. You can see Tencent's Hunyuan model ranked number 6 and Alibaba's Qianwen ranked number 8. Now, beyond language models, both of these companies are also rapidly rolling out AI capabilities across their businesses in advertising. AI implementation is driving uplift in ad conversion rates, and you have Tencent adding AI tools to make ad creation much faster. So both Alibaba and Tencent have huge potential to benefit from AI that's not being priced in, especially when compared to the exuberant valuation of certain Western AI businesses today. Now, the next space to touch on is the semiconductor industry. And this chart here shows the semiconductor manufacturing process node progress by years. Right? And you can see the smaller the number, the more advanced the technology. The light blue line is SMIC, which is the national champion of China's semiconductor manufacturing. And the dark blue line is TSMC, the current global leader in semiconductor manufacturing. We can see how SMIC used to be a whole 10 years behind TSMC at the 28 nanometer node. But over the last 5 years, that tech gap has shrunk to 5 years, despite sanctions from US. As a quick recap, US increasingly sanctioned China's access to advanced semiconductor chips, equipment, as well as software. And counterintuitively, this actually united China's semiconductor industry like never before. Before the sanctions, Chinese companies would focus on developing its own chips, own equipment, but often ended up defaulting back to existing Western solutions that were simply better. But after the sanctions, these Western solutions were no longer options. So the entire ecosystem had no choice but to lean 110% into self-sufficiency development. And SMIC has basically defied expectations using older lithography technology to advance chip making from 10 nanometer to 7 nanometer, and is expected to produce as small as 5 nanometer production starting this year. And to advance beyond 5 nanometer, China is also developing its own advanced lithography machines. Huawei and SMIC, for example, are exploring alternate tech paths different from existing ones using machines from ASML. And if it works, they could start mass production by 2026, becoming the first country to develop an alternative solution, which is currently a monopoly business owned by Netherlands ASML. And if we look beyond chip manufacturing, our investee companies like Tencent, Alibaba, and Baidu have been designing and building their own chips for AI applications. Even though chips from global leaders like NVIDIA remain better, the alternatives are starting to emerge from China. Now, the third space I want to touch on is autonomous driving. And here you can see a picture of Baidu's robotaxi being deployed in Beijing. These cars are no longer in test mode, but they're actually actively available in the public across multiple cities, fully autonomous, without safety drivers. And these services are available across 5 major cities, Chinese cities, including the likes of Beijing, Wuhan, Shenzhen, and Shanghai. And there's plans for testing of its services all the way in Europe, in Switzerland, and Turkey. And Baidu is also planning to deploy their first 100 autonomous cars in Dubai by the end of this year, with target to grow the fleet to 1,000 by 2028. So the overall number of the rides and fleet is still small, but as the tech and cost continues to go down, we will see accelerating rollout going forward. And I think unlike Tesla, which is pricing in billions of market cap for robotaxi service that's not even on the road yet, you can see the PE ratio chart on the right, that Baidu is only trading at under 10 times PE, with none of its autonomous driving technology being valued at all. Next up, I'll touch on batteries. China dominates the battery space today, led by CATL and BYD. So CATL is the global leader in EV battery technology with around 40% global market share, has continued to push the frontier of battery development. So you can see on the picture on the left, it's CATL's latest generation of Shenzhen superfast charging battery. This generation just announced the ability to add 500 kilometers of range with just 5 minutes of charging, which is essentially as fast as fueling your car at the petrol station today. And the chart on the right shows the range added after 5 minutes of charging for various companies. And here you can see CATL able to get to 500 kilometers, which is almost 5 times the range that Tesla can get from 5 minutes of charging at its supercharger station. So you can see that the technology lead that CATL has is continuing to widen over Western competition. This new generation of battery can also charge to 80% within 15 minutes in low temperature of minus 10 degrees Celsius, which is 2 times the speed of current industry standards. And beyond Shenzhen, CATL also announced new sodium-ion battery solutions. And just some context, battery makers have been researching sodium-ion battery as a potential alternative to lithium because sodium is abundant, it's cheaper, has a better safety profile. And so CATL's new launch sodium batteries is already pushing range to 500 kilometers with 10,000 battery charging cycle, which is 2 times what a lithium-ion battery can deliver. And the mass production of this sodium technology is going to start by the end of this year. And this is not happening just in China, right? So CATL has a Hungary battery plant that's set to start production soon that will help serve European automakers. And its scale and cost advantage will mean that CATL is going to remain a global leader as the whole world electrify over the next decade. So CATL is a business that we still don't own in the portfolios yet, but are actively evaluating the potential addition in recent months. Now, lastly, I want to just touch on robotics. And here again, when we think about robots, people would say Elon Musk and Tesla is leading the vision of humanoid robots. But what many don't know is China is actually already ahead of the West in this sector. And this chart on the slide just shows the number of humanoid robots unveiled over the last 3 years. And since 2022, China has accounted for more than 2/3 of total new humanoid robots unveiled globally. More than half of all global companies known to be developing humanoids are based in China. driven by local government policy support, the strong supply chain, as well as the talent pool. And just a few months ago, coming right after DeepSeek's viral movement, China's robotics business, Unitree, also went viral. Right? One of its humanoid robot demonstration, the G1 robot, was shown in a video doing backflips, kung fu moves, things that people thought, like, is this an AI-generated video? But then it became clear that the video was real, and the industry marveled at the progress Unitree achieved in substantially upgrading its robot's balance, speed, as well as dexterity. I think all in all, China is in a very good place, leading tech development for robotics as it currently stands. So now we've looked at China's world-class innovation being not fully appreciated. What else is being misunderstood? And I think, certain good qualities that are pervasive across the Chinese society, some of which are entrenched in Chinese culture and history, are also misunderstood by the market. This would be things like speed of execution, resiliency, and long-term thinking. So I'll start with speed of execution. This picture here shows the high-speed rail network map over the years in China. From just having 2,000 kilometers of high-speed rail network in 2010, by 2020, the high-speed rail network in China expanded to 40,000 kilometers. In just a short 10 years, they built by far the world's largest high-speed rail network. And over the next 10 years, this network is expected to double again. And the train technology is also expected to be upgraded, with prototype bullet trains running at more than 400 kilometers per hour. High-speed rail is going to boost connectivity between cities substantially. The flow of people is going to be boosted, as well as businesses, as well as tourism. Now, high-speed rail is not just a unique occurrence, right? You see this speed of execution across real estate, electricity grid, 5G network, EV charging network, you name it. It's truly China's speed. Now, the next I'll touch on is resiliency, where the US sanctioned Huawei back in 2018, banned it from US tech, and forced other countries to replace Huawei technology in their mobile networks. So if you recall, Huawei phones were running head-to-head with Apple iPhones back in 2018. But within months, Huawei's software access was banned, chip access were banned, and US basically destroyed Huawei's smartphone business overnight. And the revenues peaked by 2020, as can be seen on the left-hand side chart, which shows Huawei's revenue progress over the years. But fast forward 4 years. By 2024, revenue has already rebounded close to 2020 peaks. So what happened over the last 4 years? The picture on the right showcases the new flagship Huawei Pure smartphone. Essentially, within a short 4 years, they developed Harmony OS, a self-developed operating system. They no longer need Google, to which they were banned from. They now use Kirin chips, designed in-house and manufactured by China's SMIC. And the amazing thing is, not only did they come back and build their phones, replacing Western tech with domestic tech, they even found time to develop market-leading cars. So the picture on the bottom right shows Huawei's Ito SUV. So this car is better than Mercedes, with significantly better software tech and autonomous capabilities, just at half the price of Mercedes. So when we revisited what happened at Huawei immediately after US sanctions, certain anecdotes emerged, talking about how some of the engineers locked themselves in for months, not leaving till they developed the domestic replacement solution. You had the founder Ren Zhengfeng rallying the troops to fight. So this was truly the epitome of what doesn't kill you, makes you stronger. The resilience of Huawei is what we look for in the best businesses. And it comes in abundance in China, especially when we look through the period of COVID and regulator disruption. There were so many examples of resilience in education and tuition space, for example. New Oriental Education saw half their business regulated away. And then they went and built a new business and achieved record high revenues again in just a short 3 years. So this culture that celebrates resilience is really pervasive across all of China. Now the last thing I want to touch on is long-term thinking, which is highlighted in how China reformed its education and upskilled the country's most valuable resource, its people and its talent pool. So this chart here shows you the annual science, tech, engineering, and math graduate programs, STEM, essentially in short, across different countries. You can see here how China is projected to have, 4 times the amount of STEM graduates versus US today. And at the STEM PhD level, China is projected to have 80,000 annual graduates, again, around 2 times that versus the US. And this strong STEM graduate output is a direct result of education reforms that were put in place since the 1990s. So back in the 1990s, higher education was largely an elite privilege, just 3% enrollment rate. And the shift to evolve its education system was a long-term commitment over decades. So in the last 30 years, you saw China invest to build its education ecosystem, and tertiary institutions alone grew from hundreds to almost 3,000 today. And this multi-decade commitment remains today, which is going to drive continued talent output and serving as the foundation for China's growth many years into the future. Now let's bring it all back to what this means for investing and valuation. So I've highlighted how one can find best-in-class tech innovation in China, how you can find the qualities of the best companies and people in resiliency and long-term thinking. And the market continues to ignore these values, pricing the China market substantially below that of the US. And to caveat up front, we fully appreciate that China has challenges, corporate governance issues, etc. But every market has good and bad, and there's no market that's perfect. So let's look at the valuation to see whether things make sense. This chart on the left shows the P ratio of 2 leading retailers. One is JD.com, one of the largest retailer in China, and the other is Costco in the US. And JD is expected to do 10 to 13% earnings compounding going forward, which is higher than Costco's 7 to 9%, but yet it's valued at less than 10 times PE versus Costco at more than 50 times PE. So Costco is valued at more than 7 times higher multiple, despite slower growth. Right? At what point does this valuation gap simply no longer make sense? And then we also look at the table on the right, which is something we spend a lot of time thinking about. It shows the P ratio of some nifty 50 stocks in the 1970s. It's something we keep coming back to because the nifty 50s has a lot of similarities to what we see today. Back then, these businesses could do no wrong. They were strong. They had consistent growth, very, very high quality businesses, and the valuations just kept chugging up and up. Very, very similar to what we saw with Costco, Walmart, and many other quality businesses in the US today. But if you bought these nifty 50s in the early 1970s, many of these names would have given you no returns over the next decade. In the table, the third column, you can see most of these delivered negative annualized returns over the next 10 years. With McDonald's plus 2%, Disney was a minus 4% annualized, Coke even worse at minus 7% annualized, and then pharma giant Merck was 0% over 10 years. Right, so last but not least, I want to just share more food for thought around this chart, which showcases the rise and fall of empires tabulated by Ray Dalio in his book, The Changing World Order. And I bring out this chart because what you find consistently in the rise and fall of empires is that it's driven by tech leadership. So China, the orange line, was a superpower in the 1500s, invented paper, compass, silk. Thereafter, it was Netherlands, the gray line, driven by advanced shipbuilding. Then came UK, the black line, via industrial revolution and steam engine. And lastly, the US, blue line, auto, nuclear bomb, and the information technology era. So as I recounted in the first half of the presentation, probability of China taking that tech leadership from US is rising by the day. there's the ingredients for success around speed, resilience, and long-term thinking. Those things are also there. And when you look at the US market, it's currently priced for exceptionalism to continue, even as risk to that leadership grows. And inversely, China is not priced for much at all, even as it grows in technology advancement. So we find historically, low expectations typically raises probability of upside surprise, which is another reason why we continue to like our positions in China. So finally, to conclude, China is no longer copying. They're innovating and leading the way in many tech sectors. And these tech developments will be supported by a culture of speed, resiliency, and long-term thinking. We think there will be challenges related to the Chinese market, but the valuation gap we see today is simply too large, especially when we start accounting for the positives we see in the country. Now, stepping back and looking at the long-term history around tech driving country power, we see risk to US market priced for perfection and opportunity in a Chinese market that's underappreciated. So this remains why China continues to make up low double digits percentage in our Ford International Fund, 20% in our Global Equity Fund, and more than 50% in our AsiaX Japan Fund. And with that, come to the end of my presentation, and I'll hand it back to Linda.
Thanks, JC. I'm just going to pose a few questions to you before we move on. The first is that one of the reasons why investors are wary of China is that it is a country where information has sometimes been selectively communicated or even controlled. So how do you as an investor distinguish between real innovation and marketing hype when it comes to evaluating Chinese companies' claims about where they are in terms of leadership of innovation?
That's definitely a concern. So for us, we approach it across a few ways to determine the sources of information. One of it we spend quite a bit of time doing is doing expert calls with local industry experts, competitors, as well as some managers who have left companies that we're interested to understand more and study more. So this helps us calibrate what's real and what's hype. And then for various businesses that sell their products or software or other things overseas, where we have access to the underlying products, we also endeavor to actually try and test and experience and feel some of the products ourselves so that we have an accurate gauge of what this development of products actually is. And the last vector that we constantly go back to is we visit companies and businesses in China on multiple trips in a year across the team. Right, we'll go for industry conferences, we'll go on investor tours, and being on the ground really helps us talk to the local people, talk to the local businesses, and ultimately determine the hype versus again what's real information.
And also, JC, many investors also make the point that Chinese companies should trade at some kind of discount to the US because, of course, there are additional risks. One might argue investing in China, and they would risk, sort of name those potential risks as, corporate governance issues, state intervention, regulatory unpredictability. Firstly, do you agree that some kind of discount is warranted? And if so, how do you determine what an appropriate discount to the US market would be?
Sure. I think, first up, we definitely agree that some level of discount between the Chinese company and US should definitely be there. The question is how big a discount does it make sense, right? So foundationally, when we think about valuing businesses, right, we project the cash flow out and we discount it back using discount rates adjusted for country risk, right? So in this case, China would typically get a discount rate of anywhere between 10 to 13 to 14% in our valuation models. And if we translate that number into a PE ratio as a shorthand, right? So a 25 times PE ratio US business that's expected to grow earnings X% over a number of years. If there is a Chinese business with exactly the same vectors of growth and quality and so on, putting that higher discount rate typically gets us somewhere close to 17 to 18 times price to earnings ratio. So roughly call it a 30+% discount from a price to earnings ratio shorthand valuation matrix. So again, just coming back to that JD and Costco example, right? JD is under 10 times P, Costco is 50 times. The valuation gap that we see across multiple sectors and businesses in the market, China, US, the gap is just too big, and that's where we think there's the opportunity.
Okay, thanks, JC. Wim, I want to move us a bit closer to home to compare sort of the linkages between these two economies and markets. Now, you're managing a South African equity portfolio against a very resource-heavy index. South Africa's economic fortunes and indeed the performance of our equity market, given that high resource weighting, has actually historically been quite closely tied to China, obviously with them being the world's largest consumer of commodities. But over the past decade, China's growth has slowed significantly, and the economy has been shifting from one that's been more investment-led to one that's hopefully going to be more consumer-driven. That's certainly what the government is trying to do. To what extent do you think this historical resource link still holds? And what are the implications of that shift for a market like ours that's still, quite heavily exposed to the commodity cycle?
Yeah, so by and large, if we look at the decline in GDP for China, it certainly is a tale of two portions. So the consumer-led portion is still doing very well and growing strongly, and that's what JC would have commented on mostly. And then you've got the resource-dependent portion of the economy, which relates to housing and property. And there we've seen significant strain within the country. So growth rates have come down and actually tracking negative, and it's overcapacity that they need to work through. So as you've mentioned, China still constitutes more than 50% of demand for most of the commodities, and particularly if we look at iron ore, they're one of the biggest consumers by far. So we think the muted outlook for the property segment overall will definitely translate into muted commodity prices, and this is expected to continue. So while it's a big portion of the index, which means we underweight in terms of a benchmark, we do have exposure to these companies, but we've just structured it in a way where it makes sense for the outlook over the next 3 to 5 years.
And obviously a big chunk of that, sort of resources component in our index are gold producers. We have historically had a gold position in our local equity funds and across many of our multi-asset portfolios. Your comments on gold? We have a question coming through, gold versus equity markets at this point in time.
If you were to simply look at the commodity, we think there's still some upside. We're seeing a structural shift away from dollar-based assets, and especially in terms of reserves being held at the reserve banks, China shifted away and going into gold. And we think some of these structural shifts will continue. It may be gradual, but it does serve as an underpin for the gold price. For gold on its own to beat yielding assets that's actually income producing is a tall ask. So where we do see big operational leverage is within the actual gold producers. So there you can see a 10% uplift in the gold price actually yielding a significant uplift in terms of profitability. And this is what we've seen play out to a large extent within the first quarter of this year. The gold producers just running by more than 70%. So we're still fairly constructive on gold overall. We are slightly cautious on the gold players, and there we do have an underweight as well, despite having close to a 5% position, which we think is actually fairly bullish, considering all the metrics involved. These are not high-quality businesses, which is always important to remember. So from our perspective, protecting capital and making sure we do what's best for our investors, we are very hesitant to take big weightings in things that can detract over time. So we watch it closely, fairly bullish on it, but underweight nonetheless.
Okay, well, what we're going to do is we're actually going to launch a poll. So we'd like your view. We'd like you to give our vote on what you think will produce the best returns over the next, let's say, 1 to 3 years. Let's see if our presenters have convinced you of their thesis. So the question is, you should see it pop up on your screen. Which of the following do you think will deliver the best returns over the next 1 to 3 years? And your options are South African equities, Chinese equities, or gold. And here I'm specifically talking about the commodity rather than the gold producers. But whilst they are filling out that poll, Wim and JC, I'd like to just pose a question to you, which was sent through from one of our retirees. Of course, we do have many investors who are in that phase of their life cycle. And the question they put to us, and of course we've got many financial advisors online who also are managing retirees' portfolios. And the question they put through is that, there's been so much short-term volatility, and that does present short-term drawdown risks. There's been a lot of noise. Of course, we know what's happened over the year to date. How do you balance as a portfolio manager or even as an investor, the potential for short-term drawdowns or downside with that sort of longer-term upside potential, bearing in mind, that the long-term and how much of the long-term some investors have available to them may differ depending on where you are in your life cycle?
I'll maybe go first. So for retirees, the challenge is you want to beat inflation. So first of all, for any consumption needs you may have in the short term, you would want to be in more stable and more liquid, potentially fixed income assets. And there South Africa actually offers an attractive proposition. So our fixed income bonds give you a yield above inflation that's attractive even in global terms. For any portion of your portfolio where you're not looking to access within the next 5 to 7 years, you are able to take longer dated risk, and within that the volatility makes has less of an impact, and you're able to actually pick up some additional returns if you do get the equity exposure. So for that portion of your funds, we would look at any equity heavy mandates, and then definitely in terms of opportunities JC is looking at, that does look very attractive.
JC, your comments on that, investing obviously in a market that has also been quite volatile?
Yeah, I think obviously the various different products offer different type of volatilities and return profile. But what I would say is coming back to Ford's core philosophy around portfolio construction, right? We always say we don't take 0-1 risk when it comes to thinking about both investing for something that has a short-term catalyst, as well as betting on certain trends or certain turnaround stories that might take longer to come to fruition. So ultimately, what you'll find within our portfolios, the way it's constructed, is that it is not simply one factor, one time horizon, one duration, right? We generally try to take a long-term lens in terms of thinking about the true value of a business. But across our portfolios, what you'll find is that maybe you have one name that was invested, the original inception thesis was 3 years ago. It starts working in year 3, which is now. And then there'll be some other assets where we start buying into the thesis in year 1, and maybe it takes the thesis takes 3 to 5 years to bear out. So across the portfolio, there's kind of this different phases of investments that's interacting with each other, both long-term and short-term. And ultimately, we try to deliver a risk-adjusted or rather time-adjusted return that would, mitigate or provide balance to what investors are looking for, both kind of returns that track the short-term, but also finding names that have a lot of long-term misunderstanding that would deliver structural better return profile over the long run. So it's about finding that balance in portfolio construction.
Right, let's share the poll results. I see here that South African equities got a 30% vote, Chinese equities got 61% vote, and gold only 10%. So a lot voting in favor of Chinese equities, seeing that as being a compelling opportunity. So I guess, JC, you did a good job of convincing them, and I hope you're all invested in the Ford International Fund or the Ford Global Equity Fund. Of course, we have the Asia ex-Japan Fund, which is also available on some large platforms here in South Africa. But of course, those positions also come through into our multi-asset portfolios that do allow offshore exposure. So the likes of the Ford Balance Fund and the Ford Flexible Funder Funds. And I must just make the point that our South African equity fund, the Ford Equity Fund, is the top performing Ford equity fund or equity fund in its category over the last 3 years. So whatever strategy you're following there, it's working along with, of course, Nick Balkan and Nancy Hossack, who manage that fund with you. So what what we're going to do is we're just going to effectively give you a summary of what JC and Wim have outlined. We've run out of time, so I just want to leave you with the central messages that we've spoken about today. So starting here at home in South Africa, Wim highlighted just how persistent our low growth challenges have unfortunately become. So GDP has been trending below 1% for the past decade, and unfortunately the structural issues which are holding us back don't look that they're going to be changing anytime soon. But as he showed, that doesn't mean that there are no opportunities to be found. And valuations across many SA listed companies have drifted further down, which means that they are attractive from this point in time, and that does create opportunities for long-term investors who can look through some of the short-term noise. And he outlined 3 compelling examples in the likes of Capitec, a market share winner that continues to grow its market share, clients and revenues through cost leadership as well as innovation. He spoke about Tiger Brands, a turnaround story. The results today are confirming that they're on the right track. Sharper operational focus and brand rationalization are starting to unlock value for shareholders. And WBHO, which is one of the last listed construction firms standing in South Africa, so well positioned to benefit from a growing order book and margin recovery. So the takeaway in South Africa is that even if we have a stagnant economy, well-managed businesses can continue to grow earnings, and share prices, of course, follow earnings over time. Now, turning to China, JC made the case that this is one of the most misunderstood markets globally, not because it lacks innovation, but because much of that innovation is hiding in plain sight, and investors maybe are choosing not to see it. But we heard how China is making enormous strides in many areas of tech. And companies like Tencent, Alibaba, Baidu, who all feature in forward portfolios, are developing world-class technologies. And importantly, often trading at a fraction of the valuations we are seeing in similar companies in the West. He also spoke to some of the deeper structural qualities that underpin this innovation, China's incredible speed of execution, its resilience in the face of external shocks, and a strong culture of long-term thinking. Now, despite recent improvements in sentiments, Chinese equities still remain significantly undervalued and offer, in our view, a rare opportunities for investors looking to grow their capital meaningfully. So they are an allocation in our global funds. If you want more specific exposure to those opportunities, then perhaps consider the Ford Japan, Asia ex-Japan fund. So across both markets here in South Africa and in China, the message today is clear. In a low growth world, you don't necessarily need broad economic tailwinds to find returns. Of course, they certainly do help. So we hope that South Africa will start to grow quite meaningfully over time. But you can find opportunities despite that, and we are finding opportunities, which I hope you'll be comforted to hear. But what you do need as investors is clarity, selectivity, a disciplined investment process, and of course, patience. So thanks again for joining us today. Thank you to Wim and JC for their contribution. We hope you found the session thought-provoking and useful, and we look forward to seeing you again soon. There will be a survey that will pop up when you exit the session. Please do give us your feedback, and goodbye for now. Thanks again.
Thank you.